entrepreneur, hey, does the very mention of a balance sheet send shivers down your spine? Well, fear not, my friend. By the end of this video, we're going to make it so simple that your grandma's going to be cranking out balance sheets like they're Christmas cards. In this video, we're going to cover what is a balance sheet, why is it important, the formula and the easy way to understand it, all the details of a balance sheet. We're going to go through an example, and finally, the most important aspect, we're going to give you a free template in an Excel version so you could create your own balance sheet. So what's a balance sheet? A balance sheet is a financial statement that lists a company's assets, liabilities, and equity at a specific point in time. So basically, it's a list of how much the company owns in property and how much it owes in debt. What's the importance of a balance sheet? A balance sheet gives the reader a snapshot of the company's liquidity and net worth. It's required by lenders anytime you apply for funding. It's also required by investors if they're considering investing in your company. And most importantly is the balance sheet is for you, the business owner, to give you some insights on how your business is doing. The formula for a balance sheet is assets equals liability plus equity. Now it's going to do you no good to memorize this formula. I want you to actually understand it so you know exactly how money flows into and out of a balance sheet so that you're able to ride it like a bicycle. Now when I was new, it confused the heck out of me because the formula is horizontal, right? But balance sheets in finance are stacked vertically. So I'm going to show you how to think about it in a horizontal way so that it's easy to understand. I want you to imagine a rectangle right here, stacked vertically. We'll call this rectangle assets. And now imagine an equal sign above my head and two additional rectangles stacked on top of each other that are exactly the same height as our assets. Okay, now let's label the top rectangle on this side liabilities and the bottom one equities. So assets is what the company owns, liabilities is what the company owes, and equity is what the company would have left over if we were to liquidate all assets and pay all creditors. So your assets must always equal to liabilities plus equity. It's not a balance sheet if it doesn't balance. Let's take a closer look at the assets section of the balance sheet. It's broken down into two main sections. You're going to have your current assets and then you're going to have your long-term assets. Basically, it's everything that the company owns, all property, plant, equipment, cash, receivables, and it's all listed from top to bottom in the most liquid assets to the least liquid assets. So basically at the top you're going to have your cash, receivables, and then it's going to spectrum down all the way to intellectual property and patents, things that we don't have a big market for. This will all make a lot more sense when I go through the actual example coming up. Now let's take a closer look at the liabilities section. All it is a fancy word for what the company owes. It's generally broken down into two sections: current liabilities and long-term liabilities. Again, this will make a lot more sense when I go through the example. The last section of the balance sheet is equity. Equity is nothing more than what you as the owner would have left over if all the assets were liquidated and all the creditors were paid off. This section is generally divided into two subsections. You have capital stock and retained earnings. And yep, you guessed it, it's going to make a lot more sense when we go through our live example. And now the section you've been waiting for. We're going to do a live example and build out a balance sheet together. Previously, I did a video on how to put together a profit and loss statement, and we used an example of a company that sold iPhone cases, and we put together a profit and loss statement together. If you haven't seen that video, we'll put a link either in the description or somewhere on this video. So look for that, and if you want to check out how to build a profit and loss statement, refer to that video. But we're going to use the same theme, and we're going to use the same company that is distributing these iPhone cases. And basically what it did was the company bought iPhone cases for X and sold them for X plus profit. Very, very simple. So let's go ahead and build out a balance sheet for this company. Okay, ladies and gentlemen, here is a sample balance sheet. We're going to fill this out together. At the end of the video, I'll show you how you could get this template and download it for absolutely free. All right, so you may remember these columns from the early part of the video. You got your assets in green, you got your liabilities in red, and then you got owner's equity in yellow. It can be confusing for newbies since this is stacked on top of each other. So just imagine these sections right here. Move them over here. Okay, pretend they're here on this side, and there's an equal sign in between. That'll make it a lot easier for you to understand how this actually works. A couple things here, housekeeping rules. Notice how there's no numbers in these cells. Those are basically blanks. They're just header cells or title cells, whatever you want to call them. So if I put a number here, it's not going to tabulate in the total. So just be aware of that if you end up using our template. Only where there's existing numbers, those are the only columns you're going to be able to use. And of course you could modify this and all the formulas. Just Google how you can modify Excel, and if an old dinosaur like me can do it, you can do it. So anyways, let's get started. We're going to go through the lines, okay? From top to bottom. So assets are going to be laid out from most liquid to least liquid, okay? Under most liquid, you got your bank accounts, and then you have any securities that could be turned into cash right away. So stocks and bonds, basically, that are publicly traded would go here, the value of them. Then you have accounts receivable and inventory. If we're going to use the example of our iPhone case business, you're likely not going to have any accounts receivables because it's a business to consumer company. If you're a B2B company and you're offering terms to your customers where you deliver your product or service and then you bill them later, that would go under accounts receivables. You are going to have inventory though. You're probably going to have boxes of iPhone cases, and we'll end up using this row here for that. Okay, next we got undeposited funds. Basically, this is any money that's come in the form of checks that you haven't cashed yet, or checks that haven't cleared yet. It's kind of like a limbo period. Vendor prepayments. So any money that you have prepaid to any of your vendors. Let's say, for example, we have a rubber supplier to manufacture our iPhone cases, and you paid this guy $5,000 to deliver you $1,000 worth of rubber over the next 5 months. So $1,000 a month for the next 5 months. That vendor prepayment you put here because technically that's money that's owed to you. So it's an asset. All right. So next we got long-term assets, any illiquid investment. So basically the 10 grand that you invested in your buddy's EV startup, you put here. Buildings and land, self-explanatory. Equipment and accumulated depreciation. These kind of go hand in hand. So basically, let's say you have a $10,000 piece of equipment and the life expectancy of it is 10 years. So that means every year it goes down in value by $1,000. So first year it's worth $10,000 and it has not depreciated. At the end of that first year, it's now only worth $9,000, and you have $1,000 in depreciation. So these will generally balance out, and that's how you use accumulated depreciation. Intangible assets, basically this is where all the fluff goes. Your patents, IP, and goodwill, something that there is no liquid market for, something that you pretty much just assign a value. Let's say you have a patent on a certain type of iPhone case. How much is that really worth? Well, nobody knows until you sell it, and it's exchanged for dollars. So whatever you think it's worth, it would go here. All right, now let's move on to liabilities. Current liabilities, you got bank loans, you got equipment loan, you got lines of credit, credit cards, accounts payable. Basically, that's anytime a vendor has given you their products or services and agreed to bill you later, it goes under accounts payable. Customer prepayments. So this is on the other side. Let's say the customer has paid you ahead of time, but you haven't delivered the product or service. It goes there. And then miscellaneous liabilities, 1 through 4. Let's say you take on a friends and family loan from your grandma. That would go here. And then next we have owner's equity. This section, you got your paid-in capital. So how much money did you first put into the business, or if you need to continuously fund the business, you would put that amount here. And then retained earnings. Let's say the company made a $100,000 profit last year. You want to take 50 of it as living expenses and pay yourself, but the other $50,000 you want to leave into the business so you could grow the company. Then that would you would log that amount here. And then capital stock is basically the value of the business if you were to take all the assets, sell them, and then pay off all the liabilities. What would you have left over as the owner of the company? So that is basically a balance sheet. Now let's fill this in and have some fun with it. So today is February 16th, and let's say you launch your iPhone manufacturing and distribution business today. You don't have a lot of money, but you have saved up $10,000. That's your life savings, and you're willing to put it all on the line for the sake of one day having a iPhone case empire. So let's get started. Capital stock. No, sorry, that's not the one I want. Paid-in capital. You're gonna put in $10,000 as the owner of the business. That money has to go somewhere, right? It's an asset that belongs to the company. So you're gonna go to your local bank and open up a bank account and put $10,000 in it. And that's a company asset. Let's say tomorrow on February 17th, you give up and you toss in the towel and you say, you know what, this whole iPhone case thing is too difficult. I don't want to do it. Your balance sheet is very basic. It's balanced. You simply close this account down, pay yourself back, and you close the company down. But we're not going to do that because we're an ambitious entrepreneur. So we're going to march forward with this. All right. So let's say a month goes by and you bought a bunch of iPhone cases. You're outsourcing the manufacturing and you end up selling them and you make a $10,000 profit the first month. You're gonna get, now you have $20,000. It's now March 17th. I think that's St. Patrick's Day. But now the balance sheet doesn't balance. Uh-oh. So the value of your business actually went up by $10,000. But if you end up keeping that money in the business, you're not going to use this just yet. You're going to end up using retained earnings line, and you're going to retain it in the business to try to grow it even more. Sorry. $10,000. So you follow me so far? Our balance sheet, it's balancing. Great. All right, so let's say the following month, now all of a sudden, we're confident. We just made $10,000. We doubled our money. So we want to go to a bank and say, Mr. Banker, I just doubled my money in a month. can you give me a loan for $50,000? Mr. Banker's gonna say, well, why do you need $50,000? You're gonna say, well, I need inventory. Let's say he approves the loan. Now we're at $70,000. You see how both sides of the balance sheet are balancing? And let's say you make another, this time you make $20,000. So, sorry, it's 40. Because you originally had $20,000, now you have $40,000. And you decide to roll that in as well. So retained earnings goes up by $20,000. You with me so far? And this is how you keep going on and on with your balance sheet. You could potentially get another loan if you want. But this time you're gonna keep $40,000 in the bank account, and you're gonna go out and buy a piece of equipment for $10,000. So what this will do potentially is it's going to save you, instead of outsourcing your manufacturing and getting your iPhone cases for $4 a piece, your cost. Now you could manufacture them in-house for $3 a piece, and that saves you the 25%, and it'll boost your profits basically, right? But our balance sheet is still under balance, right? 140 here and 140 here, and you could play around with this and go on and on and on, and you just have to make sure when you log a transaction above this line that there's a corresponding transaction on this side. So that's really all there is to it, guys. A lot of our friends that follow this channel are real estate investors, so I'm going to quickly do an example on how you would fill out a balance sheet for a property holding company. All right, let's say you have a life saving of $250,000, and you decide to invest it into a property holding business, and you want rental property, apartment buildings, retail strip malls, what have you. So first thing you're going to do is open a bank account, right? A month goes by, you locate the perfect investment. The purchase price is $1 million, and you're gonna do a 80-20, so 20% down with an 80% loan. How would you put that on this balance sheet? We'll call our property 123 Main Street. So it's a long-term asset since it's a building. It's $1 million in purchase price, and you're gonna get a bank loan for 123 Main Street for $800,000, and then the other 20% is going to come from your bank account. So now you're only left with $50,000 in the bank, and so far we have $1,050,000 on the asset side, and then liabilities and equity we also have $1,050,000. So far so good. Let's say 6 months go by and your rich uncle hears about your deal and he wants to contribute on your next venture and give you the 20% down payment in exchange for some interest, because he's got some money laying around. So next deal comes along and you've got the property right next door. You have the ability to buy it at $1 million. Again, same exact type of property. This time though, Uncle Charlie is going to give us $200,000 for our down payment. We're going to get a bank loan for $800,000. And we have another property in our portfolio, and this is how you would show it on your balance sheet. Let's say another year goes by and your properties appreciate in value and they double. You did really well. Pick the perfect locations. There's a lot of development going on around them. You don't owe any more to anybody just because your property's doubled in value. So now you would show that right here in capital stock. You got $2 million in equity, right? So your balance sheet is perfectly balanced at $4,050,000. Just remember, any entry that goes up here has to be matched with an equal entry down here. You see, my friend, it's not that hard to build out a balance sheet. Now you're probably wondering where that template is. Don't worry, I haven't forgotten. There should be a link in the description if you're watching this on YouTube. If you're on our blog, there should be a button or a link somewhere around this video where you should be able to download a free template. If you enjoyed this video, don't forget to hit like. If you want more content like this, subscribe to our channel or join our email distribution list. For Midwest Corporate Credit, I'm PK Patel. Thank you for watching, and I'll see you next time.